Hello traders. Many times you will hear analysts mention that the market is on a risk-on or risk-off sentiment or a risk-on or risk-off environment. As a trader, it will be pretty advantageous if you can understand what the two implies, since risk-on and risk-off indicators usually give a quick perception on the direction that the market is taking. Risk aversion refers to when traders unload their positions in higher-yielding assets and move their funds to all in favor of safe haven currencies. This normally happens in times of uncertainty or high volatility in a situation that is referred to as risk-off environment. On the other hand, periods of perceived low financial risk usually encourage investors to take risk, therefore creating a risk-on environment. On this video, we will be looking at the various barometers or indicators that are usually employed in financial markets that help investors and traders to understand the risk appetite depending on their performance. One such indicator is the VIXY or VIX in short, which typically refers to ProShares VIX short-term futures indicator. It's worth mentioning that VIX tracks the performance of the S&P 500 VIX short-term futures index. The VIX, which is inferred from the prices of options on the stock exchange, is usually also known as the VIX index. It is a widely used proxy for global risk aversion and for market sensitivity to uncertainty. It is important to note that there can be differences between the actual movements of the VIX and the movements of VIX futures contracts. However, as a general rule, when the VIX rises, risk aversion is usually enveloping the global market. The second indicator that you'll be looking at is gold-silver ratio. Gold-silver ratio. Typically, a contracting economy usually decreases the industrial demand for silver, while gold tends to keep its value as a monetary asset. The reason is that silver functions mainly as an industrial metal, while on the other hand, gold serves as an hedge against economic and political uncertainties. As a result, their ratio normally, or as a result, this ratio usually goes up during risk aversion and falls off during times of risk appetite. Typically, a rising ratio means gold is outperforming silver, while a falling ratio means silver is favored. When this ratio is about to turn from bottom, traders expect risk or risk assets to fall. When silver outmuscles gold, the ratio starts to slip. As such, the market appetite usually increases. The next barometer is termed or is Vanguard Total Bond Market, BND. Vanguard Total Bond Market, BND indicator. It's worth mentioning that US government treasuries do not pay much interest, but they are considered the ultimate safe haven to park investors' money. When the return of principal is more important than the return on investment, the priority becomes finding a place to park big capital flows. When the conditions change, the money will fly off to other locations that are perceived to be safer. As such, a rising line usually implies nervousness about the global economy and usually suggests rising risk aversion. On the other hand, a price deterioration emphasizes a general optimistic marketplace. It is worth noting that when bond markets, including foreign exchange, are much less volatile than the stocks are, this indicates a wait-and-see attitude rather than a flight to safety. Simply put, according to this indicator, or the Vanguard Total Bond Market (BND) indicator, there is risk on if BND is down and a risk-off environment when BND is up. The next indicator that you'll be looking at is the Dow Jones Utilities. The Dow Jones Utilities. Typically, this is a standard that usually compares high beta and low volatility stocks. The SPHB ETF usually consists of 100 stocks within the S&P 500 with the highest sensitivity to the market movements over the last 12 months, and the large cap-oriented SPLV, on the other hand, is devoted to 100 of the lowest volatility stocks. Constructed in a similar fashion, each constituency in the SPHB is given an equal share of assets. The first includes mainly discretionary financials and technology companies, while the second reflects a more conservative investing style with large allocations to utilities, financials, and consumer staples. During defensive days, when the investors accumulate in low volatility areas, the SPLV would typically take over as the dominant percentage gainer. When risk-taking resumes, the SPHB usually leans the way. As a rule, when the Dow Jones Utilities indicator is down, it is usually indicates a RiskOn, while when it is up, it usually indicates a RiskOff environment. The next indicator is the New Zealand dollar versus the Japanese yen. And we see that the yen gives us some insight into risk appetite rising when investors do not want to deal with risk. However, there is a problem that is experienced when traders try to use USD Japanese yen. The problem with using the USD Japanese yen cross is that it is subject to the overall strength and weakness of the dollar. Even if risk appetite stays the same, if the dollar is strengthening or weakening, USD Japanese pair will change. Instead, traders look at the New Zealand dollar as the high-yielding currency, serving as a proxy for high-yielding instruments. New Zealand and Japanese have a large central bank benchmark interest rate differential, making it popular for carry trade. Therefore, the New Zealand dollar / Japanese yen pair tends to decline when risk aversion permeates the market and rise when the market is turning risk and friendly. Basically, what this means is that when the New Zealand dollar versus Japanese yen goes up, we are in a risk-on environment. Conversely, when it goes down, we are in a risk-off environment. The next indicator that is also used in the market is NASDAQ 100. This indicator, what we can see is that when money is chasing return and market mood is improving, capital tends to favor equities. As a general rule, the NASDAQ flush with technology stocks tend to imply retail money, while the S&P 500 tend to reflect institutional investment and the Dow Jones International Big Money. The allure of what is popular is hard to resist. That is why when you see the Nasdaq 100 falling, it is labeled as a risk-on environment. Alternatively, once the fear of losing subsides, the Nasdaq 100 tends to outperform as tech stocks may get irrationally sold. As indicated, we are in a risk-on environment when the Nasdaq goes up, and we usually enter a risk-off environment when the Nasdaq goes down. The next indicator that's also used in financial markets is the Global X Copper minus ETF. So copper is a barometer of economic health. It is the ones that most widely used metal after iron and aluminium. As such, it is primarily used in highly cyclical industries such as construction and industry or industrial machinery manufacturing. Copper is then considered as a coincident indicator for bond prices and utilities, which tend to fall when the price of copper rises. A rise in copper prices invites risk-on flows and shows that the markets are turning to riskier assets. On the other hand, falling copper prices usually imply economic weakness, forcing cash into safe havens. As a general rule, when we are in a risk-on environment, if the price of copper is up, and we are usually in a risk-off environment when the price of copper is deteriorating. The next indicator that we will be looking at, or that's often used in financial markets, is the HYG. Simply put, iShares iBox USD High Yield Corporate Bond. And what we see in this instance is that emerging markets are synonymous to higher growth and higher yield. However, all high returns must be judged within a risk framework. This can be potential risk, bankruptcy risk, less liquidity, and foreign exchange rate risk, among numerous others, when trading emerging market assets. Countries which offer higher yield, including Brazil, South Africa, and Turkey, are poised to benefit the most by any risk-on flows, but are also more susceptible to global monetary tightening than the developed countries or the developed market. As such, these markets display a strong positive correlation with risk. In short, as a trader, the most important thing is noting that when we are in a risk-on environment, when HYG is up, and in a risk-off environment, when HYG goes down. The next indicator that you'll be looking at is FAANGS. So FAANG is an acronym for the 5 most popular and best performing technology stocks in the market. Such stocks include Facebook, Apple, Amazon, Netflix, and Alphabet and Google. So the massive combined market capitalization of these stocks explains their dominance in several benchmark indices. Gains in these stocks are attributed to investors' continued appetite for risk. When people are buying growth stocks such as the group in FANG Group instead of value stocks which are associated with economic strengthening, the market is considered to be doing well. On the other hand, a burst in animal spirit is usually reflected in high-flying farm technology stocks turning south or when they begin falling. So the final indicator or barometer that you'll be looking at is Fidelity Consumer Discretionary, that is FDIS, versus First Trust Consumer Staples, FXG. It's worth noting that gyrations of different sectors in business cycle reflect distinct changes in the rate of growth in economic activity, as well as changes in the employment backdrop and monetary policy. When the stock market is in a process of discounting potential economic slowdown, for instance, staples tend to outperform as money chases recession-proof, dividend-paying companies like tobacco and healthcare. Consumer discretionary stocks, in turn, depend on capital spending and consumer demand and tend to outperform during periods of increased optimism. Finally, it is worth mentioning that risk aversion can lead to liquidation or profit-taking. The process of unwinding these trends may result in need to buy back funding currencies like the US dollar and the Japanese yen. When the above charts convey a sense of nervousness in the market, risk-sensitive currencies will be kept in demand. In a serious risk-off environment, one should see major shifts in the price of gold. On the other hand, should gold stop appreciating, it means that traders are not feeling the environment as dangerous. Likewise, in times of risk aversion, we would expect pairs like New Zealand dollar, Japanese yen, and Australian dollar, Japanese yen to fall lower. However, when that is not the case and these Japanese yen pairs hold well, it suggests that there is less fear than market indicators show. Another one that we might also mention is that oil prices do not like doing well in a risk-off environment, which shouldn't come as much surprise considering global growth fears and their impact on risk are intrinsically linked to future oil demand. The Canadian dollar, especially usually gain against the Japanese yen, or rather, the Canadian dollar should be monitored in extreme risky environment, whether we are in a risk-on or risk-off environment. During a risk-off environment or a risk-off event, dubbing equities for bonds is another natural response which often results in rise in the United States dollar. So that is the end of our video. Thank you for watching and let's meet in our next video.